Thank you for joining us. I'm Jill Ford and I'm pleased to welcome you to today's media briefing about Chapter 3 of the BIS Annual Economic Report. This special chapter is dedicated to the next generation monetary and financial system. So with me today for the presentation on the special chapter of the Annual Economic Report on the next generation monetary and financial system are Hyun Song Shin, Head of Research and Economic Advisor, and Andrea Mechler, the Deputy General Manager of the BIS and also the Acting Head of the BIS Innovation Hub. Before we begin, I'd like to reiterate that the remarks are currently under embargo along with the chapter and the press release. They will be released tomorrow, the 24th of June at 1 p.m. 1300 Central European Time. So Hyun will give brief introductory remarks and then we'll open the floor to questions. And I'd ask that you limit your questions to the content of the chapter itself. We will be having another briefing this Thursday on the remaining chapters of the Annual Economic Report and the BIS Annual Economic Report. So over to you, Hyun.
Thank you very much, Jill, and thank you to everyone for joining today. In this special chapter of the Annual Economic Report, we build on a proposal that we first laid out 2 years ago, the idea of tokenization and the unified ledger. Tokenization is the digital representation of claims on a programmable platform. It enables the integration of messaging, reconciliation, and asset transfer into a single seamless operation. A good example discussed in the chapter is the BIS's Project Agora on next-generation correspondent banking. Tokenization of deposits and central bank money means that all balance sheet updates in a payment using correspondent banks can be executed in one go as an atomic transaction. Beyond money, the unified ledger can also accommodate tokenized government bonds. The new possibilities this opens up can unlock efficiency gains and support new functionalities from collateral management to monetary policy operations. With careful design, it will be possible to improve the efficiency of our current system while preserving the integrity of the existing system, which is founded on 3 key principles of sound money, namely singleness, which is acceptance of payment at par, elasticity, the timely discharge of obligations preventing gridlock, and integrity, safeguarding against financial crime. The chapter also looks at stablecoins. It remains to be seen what part stablecoins will eventually play in the monetary system, besides being a gateway to the crypto ecosystem. They may have a subsidiary role to play, but they're unlikely to be the mainstay of the monetary system as they fall short on the 3 criteria of singleness, elasticity, and integrity. To achieve the next generation monetary and financial system, bold actions by central banks and other public authorities in partnership with the financial sector will be required to push the financial system along this route. Thank you, and we look forward to your questions.
Thank you very much. So we now go to questions. So we'd appreciate if you can turn on your video when you're asking a question. You can also pose your question in the chat. And if you're calling in by phone, you can also email it to media@bis.org. So just pause for a moment now and see if there are raised hands. Still waiting to check if there are raised hands. So I see Peter Thyle Larson has his hand raised from Thomson Reuters. Peter, if you're possible to turn on the video, great to see you.
Can you hear me?
Yeah.
Yeah, thanks very much. This is very interesting as always. I mean, I guess what I'm slightly struggling with is in relation to when you talk about sort of correspondent banking and stuff like that, which I sort of understand, but in relation to the sort of the core payments system and as it interacts with a central bank, what is the problem that tokenization would solve in that respect, given that you seem to have this sort of centralized ledger, which seems to work pretty well most of the time. So that's kind of the first question I have on that. And then secondly, I mean, the discussion of stable coins is very interesting. To what extent should we be looking at the discussion of tokenization in the context of central banking as a response to a threat posed by the growth of stablecoins?
Okay, thanks very much, Peter. And maybe I suggest the first question maybe answered in part by Hyun, and maybe Andrea can pick up on some of that. Okay, thanks.
Sure. So let me go first, Peter. Thank you for those questions. On correspondent banking, our current system works through a sequence of balance sheet updates. So, for example, if a customer wants to pay a supplier in another country, you would instruct, that customer, payment initiator would instruct its bank in order to set in motion a sequence of balance sheet updates. So one part of that would be in the domestic payment system. And then eventually the account of the supplier is going to be credited. So for that to happen, you need a whole sequence of balance sheet updates through many, many intermediaries, and it can be quite involved. And one of the issues that have been highlighted as to why correspondent banking, can be inefficient or involve delays is that the messaging and the balance sheet updates and all the compliance checks have to be done in sequence. So what we are envisaging in the unified ledger, which is behind Project Agora, is that you have central bank money and tokenized deposits from many institutions all on the same platform. And so once the payment is put into the system, the full path is fully visible to both the payer and the recipient, and the balance sheet updates goes through all in one go. So there is no duplication, and you don't have to rely on the sequential update. And a very big part of this will be the ability to comply with all the know your customer and anti-money laundering regulations using platform resources. And so it's going to make the payment much more streamlined. Maybe I can leave the second one to Andrea. The second, well, maybe I can start and maybe, yeah. So I think it's not true that, the idea of tokenization is, if you like, a defensive response. We had this chapter 2 years ago. It was our chapter 3 in 2023, when we already laid out, much of the, if you like, the skeleton of what the system would do. What we've done subsequently is to really provide more details, and indeed, you may know that with Project Agora, we launched it last year. We launched it in April last year, and we're making very good progress, and we'll have something to announce on this fairly shortly.
Thank you, Hyun. You said much of it. What I can maybe add is you're right, stablecoins have been used for payments, and including cross-border payment. We have seen growth in this area, but they do really lack the 3 key principles that really highlight sound money. And let me just say a few words on those. Hyun highlighted in his opening remarks is one, what stablecoins do not offer is singleness of money, because for that you really need to be able to settle your coins in using a safe asset, which in the current system is provided by central bank reserves. They also do not provide the adequate elasticity, the ability to really meet economic needs in a flexible way, and of course there's the integrity part. So while we do not know what place stablecoins are going to play in the future, what role and how important of a role, it is really difficult to see with those shortcomings that they can really become mainstream of the financial system.
Thank you, Peter. Thank you, Andrea. So maybe we'll go to the next question, and it's from, and I hope I'm pronouncing this right, Terhe Erikstad, and he's from the Dagens Næringsliv. The question is in the chat, asking how would this new monetary and financial system have been possible without Bitcoin? Here, I'm kind of reading that to believe that that's probably the technology, but if I think we try and interpret it around the technology from Bitcoin, I think probably would be the way to approach it, Hyun. And if Terhe, there's anything else you want to add in the chat, let us know.
Yeah, I think the short answer, I think, is that the unified ledger idea is pretty much separate from Bitcoin, in the sense that Bitcoin is a public blockchain. It relies on this decentralized notion of trust. So rather than having trusted intermediaries, the idea is that you can somehow have a system where trust itself is decentralized and the whole system works based on the consensus as to what the underlying state of the world is, subject to the updating of the ledger through some decentralized mechanism. Whereas the vision that we have in mind is very much based on central bank money. So it's based on the trust in central bank money, the settlement finality, and the singleness, as Andrea also mentioned. I guess the common element is the functionality that results from atomic settlement and the programmability. But the programmability, the technology underlying programmability doesn't need to farm out the notion of trust to a decentralized, consensus mechanism. So I would answer your question like that.
Thank you very much, Hyun. Next hand raised, I think, is from Isabella Kaminska of Politico. Isabella, if you want to turn your camera on.
Hi.
Hi, how are you?
I'm good, thank you. So based on the report, it seems to me both the stablecoin and the CBDC pathways are moving the system into more of a narrower banking model. But with the exception, like effectively what I understood from your report is that you believe the CBDC pathway allows for more flexibility, largely because of this ability to draw on intraday credit. I was wondering if you could expand on that and also maybe tell us a little bit more about the day-to-day fluctuations we're seeing in intraday credit in the system that merits a resolution that addresses this in this way, and what are the externalities of such a system in terms of general reserve dependency, abundant reserve dependency. And as a follow-up, why is it that you think stablecoins can't self-police in a similar way? We've seen evolution with staking, and there are plans afoot for kind of clubs of stablecoins to come together, or coalitions of liquidity. Is that not a potential way to deal with this, what you call integrity issue and elasticity issue?
Thank you very much, Isabella. There's a lot in that question, so maybe we could unpack it a bit. Hyun?
Yes, sure. Thank you, Isabella, for these very good questions. I think these are really questions that really go to the heart of the issue. I mean, firstly, on terminology, we're talking about central bank money, in general terms, and I think that's important because it doesn't have to be CBDCs in the narrow sense. We can, if you read the chapter from 2 years ago, we lay out a very broad menu in the way that central bank money can actually enter the system. I think the first part of your question is asking, why is it that the monetary system based on central bank money and tokenized deposits, would be the preferred way to go. So the customer-facing digital currency here is very much tokenized deposits. And tokenized deposits that settle in central bank money, gives us the property of singleness, which is, I think, absolutely key. In addition, we have integrity, which is basically using the fact that you have a trusted intermediary, namely the bank, that does all the customer checks and ensures that all the rules are followed. And elasticity is the property that I think you highlighted in particular. And here, let me recommend a bulletin that we published a few days ago. Maybe we can send the bulletin to Isabella on elasticity, actually. So there you will find some recent data on the very important role played by the undrawn credit lines of non-financial companies that have really tried to secure some option value in liquidity when facing a lot of the economic shocks. And the key point here is with overdrafts, which is the key way that you can actually secure undrawn credit lines. With overdrafts, it's up to the user to create money to execute payments without having to wait for incoming payments. So in a world where you have very complex interlocking payment obligations, if you had to wait for the incoming payments before you have sufficient liquidity to execute your own outgoing payment, that would be a recipe for gridlock, in the system. And this is especially the case for large value commercial payments, which is, currently conducted through the correspondent banking system. If you read the literature, it's absolutely essential to have that elasticity in order to ensure that you can execute, you can discharge your obligations in a timely way without causing gridlock. And of course, that feature cannot be satisfied with stablecoins because stablecoins need the backing reserves up front. So unless you actually have the balances already in your wallet, you cannot actually execute that payment. So I think for large value payments, I think that elasticity is going to be absolutely key. Moving to your second part, which is on why not stablecoins. Well, I think the key issue here is whether the stablecoins circulate in the public blockchain, because if it's circulating in the public blockchain, it is essentially a part of the crypto ecosystem, and it's not possible to satisfy the same type of assurances on integrity and customer checks. So in addition to the elasticity point and the singleness point, I think this integrity part is also going to be very important.
Thank you very. Do you want to come in? I think we're okay on that. Next question, I think from Li Wei Wang. You're already on camera from Kaixin. Li Wei.
Yes, thank you. So the market clearly cast very high hopes on stablecoin. I think Walmart and Amazon are all looking at issuing stablecoin, partly to overcome the high fees imposed by Visa, MasterCard, and the banks. And there seems to be a lot of inefficiency in the commercial banking system. They are slow in improving cross-border payment. So I'm just wondering, for the next generation monetary and financial system, BIS now kind of thinking about. Is that possible to have central bank reserve at the core of system, but at the same time we have stablecoin and tokenized commercial banking money competing to offer payment and other services, especially if, say, central banks impose banking-like regulation on these stablecoins. In which case, I'm wondering, can these integrity issue, anti-money laundering issues be solved with proper regulation? Thanks.
Okay, there's a lot to that question. Maybe we'll start a bit with maybe the work the BIS is doing, and maybe, or the other way around. Sorry, Hyun, you want to take it first? Andrea, okay. Maybe we'll talk first about what the BIS is doing and then go into the other aspects. Thanks, Andrea.
So absolutely good question. Thank you very much. The issue is, first of all, you're right. The current system, the current cross-border payment system in the wholesale world is actually seen as inefficient, costly. It takes T+2 to actually settle a transaction. And because of many complexity, we're also seeing a reduction in the number of banks that are willing to be correspondent banks, and also a number of FX corridors, which is an issue. And this is why it is important to find a solution and to find better solution. Now, we believe that a tokenized platform that offers multi-currencies with the banking, but in the same system, so a safe settlement asset in the form of tokenized central bank reserves to settle tokenized deposits that would be exchanged or transferred, is really a good system. And the beauty of it, that comes to the very first question we heard today: what does tokenization bring? And it does bring you that magic word, atomic settlement, right? So this is one of the big promise, is the ability to really come down with a great efficiency gain by using this new technology that can align all these difficult steps that are happening through messaging, through clearing, through checking the validity. So this is really why we believe the technology in itself has something to add. But that doesn't mean the governance. But here the point is we're keeping the same system. And this is, you ask stablecoins versus what I would call tokenized deposits, right? There are differences, right? Tokenized deposits. So if I start with stablecoins, they can be useful, they are being used, but as I say, you have the issue of singleness. They're not being accepted, no question asked, right? There are questions about who issues it, what is the safety of it. And whereas tokenized deposit have a beauty, an inherent beauty to it. It's basically fractional money, right? That's where you get a lot of the elasticity from. So you get the elasticity from the system. They're regulated, there's singleness of money because you do have a safe settlement asset to make sure that when it goes from one bank to another, it's clear that it's being transferred at par. There's that guarantee. So you maintain the trust in money, but you can use a much better, potentially a much better technology. And this is why we believe using the new technology, but applying the old time-tested principles of singleness of money, of elasticity, of integrity, which really create the basis for sound money, is really where you're going to get great advantages.
Thanks very much. I think then we go to the next question. There's a good few people with hands raised, just to say we'll get to everybody, and there's also questions in the chat. So Joasia Popowicz from Central Banking.
Hi, thank you very much for taking my question. Mine is related to atomic settlement and governance. So I saw that Project Agora is moving from the conceptual stage to the prototype stage. Could you elaborate a little bit more about, to my understanding, there is going to be a single platform, so who's going to be controlling the technology around that? Because from the digital euro trials, my understanding was that the cash and the securities still remained on separate DLTs, and it's quite tricky to bring them onto a single platform to have that kind of atomic settlement. So if you could just give a little bit more detail about the governance around that, that would be great. Thank you.
Okay, thanks very much. We are still mid-project, we should add. So, Hyun, maybe we can elaborate a little bit on what we're setting out to do.
Yeah, and that's a very good question, actually. In fact, there is a box in Chapter 3 that actually lays out exactly the considerations when we think about data and also governance. So as you know, we have 7 central banks that are part of the project, and 43 at the latest count, private financial institutions. So it is a very large undertaking, and to really make this a success, what you need to do is to actually accomplish 2 things. On the one hand, we want a platform that can really realize the benefits of tokenization. So it has to be a programmable ledger. But at the same time, we want the proper governance where the central banks involved are assured that the use of their own currency, is subject to proper, oversight from the central bank concerned. Now, there's actually a range of different designs which will accomplish this. And the way that we lay out, this trade-off is, of course, something that is a single ledger will have a lot more functionality because you can program many more things. But it will need to, centralize data and so on. And so I think governance reasons will push us more to the other side, where we have, built in some decentralization, some governance that gives the final say on the use of a particular currency to the central bank that has issued that currency. And there, there are choices between a layered architecture or what we call a subnet architecture. And there are different ways of, balancing the governance and the data imperatives together with the functionality. And, we're pretty confident that, the functionalities that we think are core will be accomplished in any of these designs. But this is something that we're actually looking at very carefully. But the final thing to say here is that this is very different from a public blockchain, where the consensus mechanism, where the consensus mechanism is completely decentralized.
Thank you very much. Next hand raised, I think, in order is Bastian Benrath from Bloomberg. Bastian, if you can turn on your camera, would be great.
Hi, I hope you can see me. I have turned on my camera.
Yes, we can see you. Yeah.
Is that true? Yeah, wonderful.
Yep.
Hi. Thanks for taking my question. Very good to talk to you. I have a, I think, rather simple question. The unified ledger ecosystem, which you're laying out in the chapter, can you give us an estimate of when you think that will come into play, like when this will be introduced? And in the process of answering that question, maybe you can talk a little bit about the feedback you have gotten from central banks about introducing it, like from your peers around the world. Thank you so much.
Thank you very much. I think we talk a little bit more about Project Agora in that respect. Okay, Andrea, if you can take that.
Well, thank you very much, Bastian. Look, first of all, I think it's important to remember all the time that our project are experimentation. So this is not something we necessarily go to the market with. I think the approach that we're taking is very much a baby step approach. So we'll have to really, the point is exactly to test all these difficult, putting together, choosing the platform, putting them together, giving the confidence to the central banks that they can have the control they need about the currency, that the tokenized deposits can be flowing across the platform. So all of this is likely to take some time, but we also want to show some results as soon as possible to be able really to understand the power of the technology and how it can be best used. Hyun?
Yeah, thank you, Bastian. I think the and what Andrea said is I think the most important, that we're actually still in the investigation stage. But I think it's worth saying that there is tremendous impetus that's coming from our private sector partners on this project. You know, we have 43 private sector institutions that are part of Project Agora, as well as the 7 central banks. And what's really distinctive about this project is that it's not simply a tokenization platform that is siloed within one institution. It is very much a interoperable infrastructure. So it has central bank money, which is in the same venue as the tokenized deposits, and so you can imagine settlement across the tokenized deposits of different institutions. Not to mention, actually, the tokenized deposits across different currencies, even. And so it's a very, very important leap that we're envisaging here. And the role of the central bank is absolutely key because settlement in central bank money is what actually ultimately enables bringing all the pieces together. So the technology by itself is not the new thing because many commercial banks already have their siloed tokenization platforms. But the key is to really bring all of those together to have a platform that is interoperable and across all the major currencies in the world. So that's the big leap. And so I don't think we should underestimate how important it is. And you can imagine that for the private sector, this really is a game changer. So, it's really the private sector partners that have really been pushing us very hard on this.
Thanks very much. Okay, thanks, Bastian. Next, there's a question in, and I think we probably just maybe want to expand on it a bit. Anna Reitman from Vanadium News and Opinion is asking about our analysis of the repo markets and how we can expect them to develop. We make reference to them in the chapter. Hyun, do you want to take that?
Sure. Thank you, Anna. When we talk about the trilogy between central bank money, tokenized deposits, and tokenized versions of government bonds, we're envisaging, these 3 types of instruments on the platform. Now, in Project Agora, we're focusing on just the money part, on tokenized deposits and tokenized central bank money. The project that discusses tokenized government bonds is a project that we discussed recently, Project Pine. I think we can send you some material on that. Now, this is still very much experimental. And again, just like my answer to Bastian in the previous question, already commercial banks have their own proprietary tokenization platforms that have looked at this, and they are providing the tokenized services on repo. But clearly, if we had something that also had the central bank on the platform, that would actually enable something which is much broadly, much more encompassing in its scope and much broader in its coverage. So the new functionalities include things like being able to pay interest by the hour rather than the current system, which is a very sharp distinction between something which is interest-free during the day, but then paying interest only if you hold it overnight, or collateral management, for example, being able to exchange money and the collateral in an atomic way, so that we have payment versus delivery, for example. So those kind of functionalities are fully envisaged there. So I think the key is not the technology itself, because that's something that's already available from commercial banks on their proprietary platforms. It's more that with the central bank there on the platform, you will have something which has much broader coverage.
Thanks very much. A question from Aliyah Shibli from the Financial Times. And I think we might have broadly answered it, but if in case there's anything you want to add, how will central banks provide access to tokenized reserves, and what will commercial banks need to change operationally to use them? Andrea?
Okay, maybe I can start. Yeah.
Okay.
So the short answer to that question, Aliyah, is not much, because even some real-time gross settlement systems, RTGS systems, so-called, which are the backbone of the large value payment system, already have some programmability, functions, and so it would be very easy to access those kind of services without necessarily having a special tokenized, version of central bank money. But if we go one step further and have central bank money in tokenized form, together with tokenized deposits on the same, in the same venue, all that would take is to make sure that there is a mapping from the balance sheet of the commercial bank to the token, so that when you transact a token, that is, will have the same effect as having access to the underlying deposit. So, in a way, this is the beauty of the proposal, in that this is not going to need something radically new. It's very much the current system, but with some additional functionality.
I think that covers the. Or do you want to add? Yeah.
If I get the mic, maybe if I can add just for the broader understanding is absolutely. So again, right, technology, the things you can test, the things you may have to work on, but that's not the difficult thing. It has been used in many different areas. The point is to put it together. Another thing that, and this is where the BIS Innovation Hub is also being instrumental, is also understanding how do you link the world of what is happening on one of those tokenized platforms. Actually, it's not platform. I'd rather call them ecosystems, because once you put tokenized deposit, you have tokenized central bank reserve, but you may also have tokenized government bond, for instance, and you can really create an ecosystem. How do you link it back to the existing system? And for instance, there's one project at the BIS Innovation Hub that is looking, or has been looking also, on RTGS bridges. So I think there are a number of questions, but those questions are often more from a governance perspective, to make sure how do we set up the right governance so that they really work and are safe to use.
Thank you very much, Andrea. There's also a hand raised by Mark Jones from Reuters. Mark, if you want to turn your camera on.
Hey there. Thanks. I've got basically three, in theory, quite basic questions. In the report, you were talking about the tail risks from stablecoins, of fire sales of safe assets. Can I ask just a really stupid question? And could you give us a basic explanation of how that might happen and play out in the real world? The second one is, can you maybe talk specifically about the risks of Tether and USDT? You mention it kind of very briefly in the report, but considering that that's pretty much half of the stablecoin market, and it kind of, when Europe went to regulate, it moved out of the region. Can you give us just a quick thought on that? And a very big picture final question. You were talking about the issue is that the singleness of money. If one of the big national treasuries were to issue a stable coin, does that kind of get around that issue of singleness of money? And ultimately, if someone like the US Treasury did issue its own stable coin, is that feasible? And what kind of impact would that have on everything in the world?
There's a lot of hypothetical, I think, questions in that. Maybe we can unpack some of that. Hyun?
Hello, Mark. Let me just answer these fairly briefly, and then I'll turn to Andrea for the more detail, for the more sort of detailed answers. So on fire sales, the discussion there is drawing on the analogy between money market funds and stablecoins. in that they're both claims that are backed by the underlying assets, and we've seen fire sales from the redemptions from money market funds in the past, and so it's really asking the question, if there were something like that in the stablecoin space, what would be some of the consequences? It's not a forecast; it's simply a sort of hypothetical exercise. On Tether, let me not mention specific, coins here, but just refer to the integrity issue that's in the report. If a claim is circulating on the public blockchain, it's very difficult to ensure the same level of integrity against money laundering or financial crime as we have, currently. And on stablecoins, the notion of the singleness of money is not about whether it's issued by, a public entity or a private entity. It's more about the idea that settlement ensures that it's received, it's accepted at par. There's a no questions asked. With stable coins, there's always an issuer that is tagged onto the balance. So when you wake up in the morning, you check your phone, you have 10 red dollars, 10 blue dollars, and 10 white dollars rather than $30, because you have $10 each of different issuers, and that's what you have if you have a bearer instrument rather than money that's settled on the on the central bank. And in the chapter, we say, look, it could be that the exchange rate is very close to 1, but it's never exactly 1. You will have a fractional deviation, and in that sense, there is a departure from the singleness. So singleness is not an approximate notion. Singleness is either you have it or you don't. Just going to check if.
Maybe I can. Hyun, great answers as usual. Maybe on the risk of the stable coins, without naming them, Hyun, really you focused on the integrity, on the AML, which is really an important one. I would say, right, the big categories. The other one is and I think it also comes with that concern about singleness as well, it will always have the question about the quality of the asset backing. Is the money really there? Where is it? So the whole question of disclosure, and this is where some of the stable coins differ, is on the transparency and hence the trust that the money that is supposed to be backing the stable coin is really there. And the other one is really about this quality of what I'm going to call quality of the platform, quality of the network on which they are running, which is much more important in the case of stable coins than it is if you think of the banking or traditional financial system. I mean, just to give you an idea, right? It's the whole question: is the network permissionless? Are the transactions going through hosted wallet, unhosted wallet? There are also issues about on versus off chains. So all of these questions become much more important in the case of stable coins, and are really clearly also new types of risk that investors and users have to really get to know much more about.
Thank you very much. Now, I'm just going through kind of other questions. There was a question from Nikki Morris, who was talking about like the market demanding kind of different innovations and kind of stable coins having a moment. But as far as I can see, Nikki, we've answered the question, because your question was about the timing of providing alternatives. So, Nikki, unless there's anything else you want to add to the chat, I think we've probably adequately answered that, just looking at time. There's another question from Maureen Kahn from The Times, who actually is talking about retail creating CBDCs, is asking, kind of mentioning, I suppose, the change that some countries are moving away from retail CBDCs, and asking about the development of retail CBDCs and whether they're being implemented or not being implemented, as some countries are choosing to do. How does that move towards, how does that impact the move towards tokenization envisioned in this report? So, Hyun, thanks.
Hello, Maureen. I think the short answer to your question is that it really depends on the jurisdiction. It's a decision by the jurisdiction. We say in the report that some jurisdictions have certainly considered retail CBDCs, but have chosen not to issue those because many of the advantages are already captured in the retail fast payment systems, which are conventional payment systems that are settled in central bank money. Some jurisdictions are thinking about retail CBDCs, as part of a broader strategy. And I think the choice really depends on what kinds of attributes that you're really after. In the case of the ECB, there have been many speeches on this. If you read the speeches by Christine Lagarde or Piero Cipollone, they lay out exactly what is going through their minds. And in the case of the ECB, having a pan-European public infrastructure, I think, is a very important consideration. So I think that's probably enough, from us on that.
Thanks very much. So I see James has a hand raised again. I'm just making sure I'm fair to everybody. I think we've gone through all the questions in the chat. So if there's no new hands, then James will come back to you. And if you want to turn your camera on, that's great, so we can see you.
Hi, I'm afraid my camera's not working.
Okay,
Can you hear
you're
me?
there. Yeah. Okay.
Yeah, cool. So I had two questions. The first was on the coming back to the governance, where you didn't really answer. So in your box you have these subnet ledgers and layered ledgers you talked about, but the layered ledger would still need governance for the layer one, and the subnet ledger would clearly still need overall governance to decide which subnets are connected or potentially disconnected in some event. And so I was hoping you could just talk about how you would manage that governance between them, because clearly the big design decisions would have to be taken by somebody, and design changes and so forth, which could be very important, and potentially disconnection, and who gets to decide about that in cases of war and so forth. And then the second question, just you've been quite dismissive about bearer instruments, but one of the things people like about money is that it's a bearer instrument. This is the popularity of cash, and obviously there are lots of things where people don't want that, but the sort of it's right there in the founding document of Bitcoin was to try to be a bearer. The big advantage of it was that transactions can't be reversed, which you only really get with bearer instruments. So just wondered if you could talk a bit about that.
Jan?
Hello, James. Both are very good questions. So I'm glad that you're really sort of into the governance aspects, actually, because if you look at the box that we have, we go into some of the details, but I think some of the questions that you're raising, I think, are really key ones. So there are a couple of important principles here. So when you have a very centralized design, you have to have the data in one place, and the operations will have to be automated in some ways that will give less discretion to the central banks involved. And so when we design this, we have to balance the governance imperatives together with the functionality. Now, I think one key piece of this would be that the central bank of a particular currency will need to have, if you like, final say in the use of that currency. And so when we design the ledger itself, there has to be at least that level of decentralization where the central banks would have final say in the use of their currency. I think the other important piece, of course, would be the data. So where does the data actually lie? Where does it reside? And there again, some degree of decentralization, where you have the data governance requirements really sort of built in from the very beginning, will be very important. And there are plenty of cases actually that we have already looked at in the Innovation Hub. So a very early example was actually Project Jura, which I think Andrea could also, describe, more fully. That was a project between the Eurosystem, in particular the Banque de France, and the Swiss National Bank. And we had two currencies on that platform, the euro and the Swiss franc. And we managed to build in the governance by having, two notaries. So, the two central banks were the two notaries, and a payment would go through only if both notaries were actually, signing off. So there are ways of doing this. Now, exactly which design will depend on, the terms of that trade-off between additional functionality and the additional governance safeguards. And so in the layered architecture, of course, the layer one will just be the, will be the kind of the technical aspects, which once you put in the inputs will grind away and, give you the outcome. And so it's very much the second layer that's going to be important here for all the governance reasons. And similarly with the subnet. And for the case of Jura, we very much use a subnet structure for that. On bearer instruments, I'm certainly not being dismissive of bearer instruments, James. So and certainly cash is very, very important. I think it's a very, very important element of the monetary system. This direct connection with the issuer. It's more that if you think about large value payments, and the cash in advance constraint that bearer instruments actually impose on you. What we say is it's unlikely that they're going to be the mainstay of the monetary system, but certainly we're not being dismissive about bearer instruments.
I'd like to add, if just a couple of things, because I loved it when you said, people like bearer instrument because, and if I quote you correctly, transaction cannot be reversed. And I like it because it reminds me also, it's not only the reversal of it, but it's also this irrevocability and finality of transaction that is so prized. And when you think about it, this is exactly what at the time in the 80s an RTGS system managed to do, right? It managed to, usually it was only cash that allowed. Once you get your cash in your hand, it's your money and you know what it is. The money still has to have a good stable value for it to be valuable, but that is cash. But now I'm not talking tokenization, but in the current system, the current way the system works is exactly by replicating that irrevocability and finality of transaction. And when does it do it? Is exactly when you settle your transaction in central bank money. And now go into the future, or where we are now, in a tokenized world, that's exactly that given system that we want to replicate. And I think that is the beauty of it, is to have transaction that cannot be reversed in the sense they are irrevocable, they are final, you know what you have, you know where it is, you know what the value is. And I think that is really key. And I think in that sense, it doesn't only come into, whether it's cash or stable coin, and we've shown some shortcomings, but is a really core principle of the system that we want to build.
Great, thanks very much. So we're coming to the end now. There's two questions of clarification, which we just maybe pick up before we close. So one was Isabella Kaminska from Politico asking, does the BIS see tokenized deposits as an alternative to a CBD system or as coexisting within a CBD system? So it's probably worth unpacking what's meant kind of by CBDCs. So if you wouldn't mind taking that, Hyun, that would be great.
Yeah, thank you, Isabella. I think it's so of the two alternatives. What we're laying out is a design where the customer-facing aspect, the customer-facing instrument is the tokenized deposit. So the idea is not that central banks provide an instrument directly for everyday use. So the two-tier structure is still very much part of this trilogy that we lay out and the unified ledger. For the CBDC system, I think you're referring to the retail CBDC design, and we had a question earlier about that, and I would just refer you to that. But the answer to your question is we think of the tokenized deposit as being the primary payment instrument that the public will use.
And then there's a final question as well on Project Agora about private sector firms moving into tokenized deposits. Let me just bring up the question. It was from Li Wei Wang. Is Project Agora's aim private sector firms moving into tokenized deposits?
The answer is yes. Yeah, so it's a project where we have 7 central banks and 43 private sector institutions. They're mainly commercial banks, and they include all the major commercial banks that are included that are currently active in the correspondent banking business, which is really the backbone of the current system.
A slightly different way to saying it is the Project Agora's aim is really to improve or explore how to improve the current correspondent system using new technology, as we discussed earlier.
And there's a question, Nikki Morris, it's just a question of clarification. I'm not sure if there's a question in it as well. She was talking about I suppose the risk of ceding ground to stablecoins because there isn't a solution there. She's not suggesting wholesale CBDC on a public blockchain, on a public chain, but tokenized deposits settled with CBDC. So I think the broad thrust of her question is the kind of central bank ceding ground to stablecoins as a risk. I'm not sure if is there anything we want to add in relation to that?
Yeah, thank you, Nikki, for that. I mean, there is quite actually extensive discussion in the chapter on the public blockchain nature of the infrastructure behind stablecoins. So our view is that they may eventually have some use, but it remains to be seen what role stablecoins will have. Stablecoins that actually trade on the public blockchain will have beyond their current main role, which is to serve as the gateway to the crypto ecosystem. I think it remains to be seen, but for the reasons that we laid out, fairly extensively, and in particular because stablecoins don't do a good job on singleness, on elasticity, and on integrity, we don't really believe that they have the potential to be the mainstay of the monetary system in that sense. And so I guess that's pretty much answering your question.
Thank you very much, Hyun. So we're out of time. I think we've answered everybody's questions. So thank you very much, everybody. A reminder again about the embargo. The embargo lifts tomorrow. That is Tuesday, the 24th of June at 1 p.m., 1300 Central European Time. Thank you very much, everybody, for your attention. And you're also invited as well to the next briefing, which will take place on Thursday. And we will see you then. Thank you. And if there's any questions, we can follow up with them separately. Thank you, Andrea, and thank you, Hyun.